All right, welcome back to the Explainer Desk. Today, we are putting on our professional equity analyst hats because, well, we're diving into a rigorous top-to-bottom stock valuation. We are focusing on pricing an absolute giant in the offshore drilling sector, Transocean, known by its ticker symbol RIG. We're going to completely strip away all that market noise and just use hard, cold financial data to figure out this company's true intrinsic value.
So right off the bat, I want to hit you with this absolutely stark number. Negative 131.41%. According to the latest financial metrics, this is Transocean's calculated margin of safety, and that's based on its baseline free cash flow. Now, if you know value investing, you know you usually want a positive margin of safety, right? Meaning you're basically buying a stock for less than it's actually worth. So a deeply negative number like this, yeah, that throws a massive red flag right out onto the field.
And honestly, that brings us to the central mystery of today's explainer. Is the broader market just completely wrong about Transocean? Or are our traditional valuation models missing something fundamental about how this specific business operates? To figure that out, we literally have to perform a complete exhaustive valuation using 4 major model categories.
Okay, here's our blueprint. First, the starting point, where we pull the raw facts. Second, absolute valuation. Third, relative valuation, where we look at peers. Fourth, asset valuation. And finally, the synthesis, to get our final intrinsic value.
Section 1. Starting point. The analyst's baseline.
Before we run any complex formulas, we have to establish the baseline realities of Transocean's financials. And honestly, there's an incredible contradiction in the data here. So, Transocean has a last close price of $6.84, which gives it a market cap of just under $7.6 billion. Over the trailing 12 months, they've actually generated a very healthy $626 million in positive free cash flow. But look at the bottom line, a deeply negative net income of negative $2.915 billion. This massive, glaring gap between positive cash flow and huge accounting losses, that's going to be the central tension in all our models today.
Now, to run proper valuation models as analysts, we got to make a few sensible, standard assumptions just to fill in the gaps. We're going to apply a 10% weighted average cost of capital, or our discount rate, basically to account for the inherent risk of the offshore drilling industry. We'll use a pretty conservative 2% terminal growth rate and a standard market risk premium of 5.5%. And for our peer comparisons a bit later, we'll assume standard industry competitors like Valaris and Noble.
Section 2. Absolute valuation. Valuing the cash.
In these absolute models, we frankly do not care what the market thinks. We are trying to find intrinsic value purely based on the cash the business actually generates. Think of our first absolute model, the discounted cash flow, or DCF, kind of like a simple recipe. Step 1, we project out that $626 million in free cash flow to the firm. Step 2, we discount those future cash flows back to present value using our 10% WACC. Step 3, we calculate a terminal value, assuming the company just grows at 2% forever after our projection period. And finally, we divide that total enterprise value by the number of outstanding shares.
And wow, this brilliantly illustrates the harsh reality of cash flow valuation. The DCF calculation outputs a fair value price of exactly $2.96 per share. Remember, the stock is currently trading at $6.84. So, according to strict, absolute cash flow generation, Transocean is severely overvalued. And there it is. That is exactly where that negative 131.41% margin of safety from earlier comes from.
Okay, so the DCF looks pretty bleak. What about our second absolute valuation tool, the dividend discount model? This model finds intrinsic value by looking strictly at the expected future dividend payments a company is going to send to its shareholders, discounted back to today.
Well, looking at our data, Transocean's dividend compound annual growth rate is exactly 0%. They don't pay one. And, you simply can't discount cash that doesn't exist. So the DDM model completely breaks down here. We got to pivot. Which brings us to our third absolute valuation method, the residual income model. Now, this model starts from the current book value of equity and then adds future residual income. But remember that massive contradiction we noticed a minute ago? A solid positive free cash flow of $626 million versus a staggering net income loss of nearly $3 billion? Because the residual income model relies so heavily on net income and equity charges, it literally falls off a cliff here. The data shows Transocean has a highly negative return on equity of negative 35.95%.
When you subtract the massive equity charge from their deeply negative net income, the residual income intrinsic value plunges way below zero. So, from an absolute valuation standpoint, across DCF, DDM, and RI, the current $6.84 share price is just completely unsupportable.
Section 3. Relative Valuation, Comparing to Peers. All right, so if absolute cash doesn't support the price, what on earth does? Let's check the market temperature against comparable offshore drillers. The trailing price-to-earnings ratio is negative 2.19. Obviously, you can't price a stock on a negative PE, so we look forward instead. The forward PE is a very optimistic 3.84, meaning analysts clearly expect a massive swing back to profitability. The enterprise value to EBITDA sits at 8.94, which is fairly standard for a super capital-intensive industry like this. And their price-to-sales ratio is 1.92, showing the market is actually willing to pay a slight premium for their top-line revenue.
So the absolutely crucial point here is this. Relative valuation models explain the current stock price vastly better than absolute cash flows do. The market isn't pricing Transocean based on the nearly $3 billion it lost last year. No way. It's pricing the stock based on that forward PE of 3.84 and standard EV/EBITDA multiples, heavily betting on a future offshore drilling turnaround. If we price rigs strictly based on these forward P multiples, an intrinsic value of around $6.50 to $7 per share actually looks, well, perfectly rational.
Section 4. Asset Valuation, the Liquidation Floor.
Sometimes, a company's value isn't in its cash flow or its peers at all, but strictly in the physical assets just sitting there on its balance sheet. We're looking for the net asset value, or NAV. Transocean trades at a price-to-book ratio of 0.93. Their debt-to-equity ratio is a very manageable 0.70, which honestly is surprisingly decent for a distressed driller, and their enterprise value-to-assets ratio is 0.78. The most important metric here, for sure, is that 0.93 price-to-book. By definition, if a company trades under a 1.0 price-to-book ratio, the market is literally valuing the company for less than the theoretical liquidation value of its assets. If we take that $7.59 billion market cap and just adjust it upward to reach a 1.0 price-to-book parity, we discover a net asset value floor of approximately $7.35 per share. Let that sink in. The raw steel of those offshore drilling rigs is literally worth more on paper than the stock price.
Section 5. The Synthesis, Final Verdict.
All right, we've run all the numbers, so let's bring these distinct models together at the analyst desk. There is an incredible, massive discrepancy here. Our strict math-based DCF absolute valuation implies a share price of just $2.96. The dividend and residual income models essentially break entirely and imply a value near zero because of those massive accounting losses. But when we look at relative peer multiples, we get a value right around $6.50 to $7. And then our asset-based NAV model points up to $735.
So, as a professional analyst, how do you synthesize numbers that are this far apart? Well, we use a weighted final intrinsic value. I am heavily weighting the DCF at 40%, because at the end of the day, hard cash reality matters most. I'm giving a token 10% to the broken DDM and RI models, just to respect the massive negative net income. But I'm also weighting relative valuation at 30% and the NAV asset value at 20%, because in heavy industry like this, the physical rigs and the broader market cycle carry legitimate real-world weight. When we blend all of this together, we find that the current $6.84 market price actually sits right on the edge of fair value if, and literally only if, you're purely buying offshore drilling assets and betting on a future turnaround. However, if you're a strict value investor looking for reliable current cash flow, the stock is aggressively overvalued. The current price is completely detached from today's cash realities. Which leaves us with the ultimate question you have to answer before putting any money into this. We know the massive offshore rigs hold physical value on the balance sheet, but will Transocean's heavy assets ever generate enough actual absolute cash flow to justify that 6.84 price tag on a simple DCF basis? Honestly, that is the billion-dollar question. Thank you so much for joining me for this valuation masterclass. Keep learning, keep analyzing, and I'll catch you on the next explainer.